We know what it feels like to be nickeled and dimed to death thanks to no-frills airlines, resort fees, overdraft charges, and ATM fees. Not to mention the master of tickets making it oh so convenient, fee, to attend the Brooks and Dunn reboot tour. But that's amateur stuff compared to the hundreded and thousanded to death feeling the IRS provides. Case in point, the net investment income tax, or NIIT for short. Nitpicking, I say. Come on, Uncle, haven't we had enough bleeding already? Let's take a look at what it is and how it works. First, it applies to investors. If you're not investing in anything, forget about it. But I will say you should be an investor. You don't want to be the only one working the rest of your life. You want your money working too, for you. But that's another discussion. Investors might be subject to a nearly 4% tax if they have investment income and their modified adjusted gross income exceeds a certain amount. All right, let's dig in. What's investment income? Capital gains count, short and long term. Short, you buy and sell an asset in a year or less. Long term, a year and a day or longer. Dividends due, both qualified and non-qualified. Taxable interest, but not municipal bond interest. Rents and royalty income. And you don't have to be a king to get royalty income. Could be a payment for copyrighted material, payments for natural resources on your land, or even a musician getting paid every time their song plays on the radio. Passive investment income counts. The taxable portion of non-qualified annuity payments. That's an annuity purchased with money you've already paid tax on. Only the earnings are taxable. Business income from stock trading. All right, what doesn't count for the NIIT? Your paycheck. Social Security or veterans benefits. Unemployment payments. Withdrawals from 401ks or IRAs. Pension payments. Municipal bond interest. Proceeds from life insurance. Income from a business you're active in, meaning you're working it on a regular basis. And the tax-exempt portion of the sale of your primary home. If you have some income that does count, the next step is to compare your modified adjusted gross income to the NIIT thresholds. Yeah, the IRS throws around the term modified adjusted gross income like a cook at Waffle House throws around the hash browns. It kind of depends on the mood and what they're talking about. For these purposes, it's essentially your adjusted gross income with tweaks for foreign deductions or income. Don't have any of that foreign stuff happening? Then your AGI, adjusted gross income, and MAGI, or Maggie, the modified adjusted gross income, are probably the same. If your Maggie is greater than the thresholds, then you're subject to the NIIT. $200,000 is the level for single filers. Married filing jointly, it's $250,000. Here's how it works. If you have investment income and go over the threshold, you pay the 3.8% tax on your net investment income, or the portion of your modified adjusted gross income that exceeds the threshold, whichever one is less. Here's an example. You've got $20,000 of net investment income. Your modified adjusted gross income goes over the threshold by $40,000. You'll owe 3.8% on the $20,000 as it's less than the amount you're over the threshold. In this case, that would be $760. All right, let's try another scenario. Your net investment income is $20,000 and you're over the threshold by $10,000. You'll pay the tax on the overage as it's less than the investment income. $380 is the NIIT in this one. Unlike the convenience of fees to attend a concert, this feels inconvenient and confusing. I say, crank up the government acronym generator, the GAG, and rework NIIT to no interest in this, and Maggie to make America go insane.